So, how exactly did a simple online bookstore grow to absolutely conquer the internet? Well, let's dive right into this explainer because it's a completely counterintuitive story. We're talking massive risks, a total near collapse, and a brilliant hidden profit engine that completely subsidizes what you and I see on the surface.
Just to wrap our heads around their incredible scale, consider this. Amazon accounts for nearly 40% of absolutely everything sold online. That's 5 billion items shipped in a single recent year. I mean, it's a logistics machine unlike anything the world has ever seen, right? It's just functioning at this mind-boggling volume.
But, here's the central mystery of this entire story. Despite those massive shipping numbers, the famous retail marketplace that we all use actually loses money on nearly every single purchase. It totally defies standard business logic. How can a company be so incredibly dominant, ship billions of items, and yet bleed money on those very sales? Let's unpack that.
Part 1. The Regret Minimization Framework and the 1994 Internet Boom. To really solve this financial paradox, we've got to travel back a bit. Back to 1994, when e-commerce was growing by a staggering 2,300%. A young executive named Jeff Bezos was watching this explosive growth, and he actually left a highly lucrative Wall Street career to chase it. Why? Well, he was driven by this philosophy called the Regret Minimization Framework. Basically, he knew that at age 70, he'd never want to look back and regret missing out on the early internet. So he packed up his life and moved to Seattle. In the very beginning, he initially incorporated this new company as Cadabra Inc. But, as you might guess, it sounded a little too much like cadaver, which is not great for branding. He then pivoted to Relentless. And actually, fun fact, if you type relentless.com into your browser today, it literally still redirects to Amazon. Finally, after some friends pointed out that Relentless sounded maybe a little too sinister, he settled on the name we all know today, Amazon.com. Okay, so once the name was set, what exactly was he going to sell? Bezos initially brainstormed 20 different product categories, hoping for a really wide variety of products within each one. He narrowed it all down to these final 5. But ultimately, he chose to focus entirely on books. Why books? Well, because of their massive global demand, the incredibly vast selection of titles out there, and, crucially, their relatively low price point. And that dedicated book strategy, it was an absolute instant hit. I mean, within just 2 months of launching, they were already selling books in 45 countries and pulling in $80,000 a month in sales. That kind of rapid early success is what propelled the company to a highly successful public offering on the NASDAQ in 1996.
But, being a huge disruptor rarely goes unchallenged. Despite facing lawsuits from traditional retail giants like Barnes & Noble, who literally claimed Amazon wasn't a real bookstore, and Walmart, Amazon just kept right on expanding. Both of those suits ended up being settled out of court, by the way. And by 1998, Bezos decided that just selling books wasn't going to cut it anymore. He wanted the company to become the everything store.
Part 2. Surviving the dot-com crash.
So, becoming the everything store made revenue absolutely skyrocket to nearly $1 billion, and investors were, of course, ecstatic. But this perfectly set the stage for the disastrous dot-com bubble. When investors eventually sobered up and realized that, hey, tech startups with zero profits probably shouldn't have these massive valuations, the bubble burst. And it burst violently. It completely wiped out 95% of Amazon's stock value, sending it plummeting from a peak of $113 a share all the way down to a measly $5.51. Amazon barely survived that crash, kind of limping alongside companies like eBay, but they found themselves facing serious corporate stagnation in the years that followed. So to fight this off, in 2005, they made a massive, incredibly risky bet. They launched Amazon Prime. By offering free 2-day shipping across the US, they made a move that virtually guaranteed they would lose money on every single shipped item, just because of the wildly increased logistics costs.
Which brings us to Part 3, the secret profit engine.
Okay, so think about this. If Amazon Prime loses money on every single delivery, even to this day, how on earth does this company completely dominate the global market? Well, the answer lies in a very quiet decision they made back in 2005, the launch of a subsidiary called Amazon Web Services, or AWS. It's essentially this massive cloud computing company that handles the back-end hosting for other businesses all over the world.
To really grasp why this was so totally disruptive, you have to look at the costs. Before AWS, building a tech startup meant buying really expensive physical hardware. A single traditional server could cost you up to $5,000. But AWS, they changed the game. They allowed businesses to affordably rent server space in the cloud, based purely on how much they actually used, which often dropped costs to just $500 to $1,000 a year. It was a total game changer.
This model completely revolutionized the internet. It was just such an incredibly affordable way to host your operations. In fact, AWS grew so fast that it now hosts roughly 34% of all websites today. It aggressively left major legacy tech giants like Microsoft, Google, and IBM completely in the dust when it comes to cloud infrastructure. Seriously, not even close.
Now, the financial breakdown between these two sides of the company is absolutely staggering. The famous retail marketplace, the Amazon we interact with every single day, pulled in $160 billion in revenue, but it actually ran at a $200 million loss, mostly due to those crazy prime shipping costs. Meanwhile, over on the AWS side, on just $17.5 billion in revenue, they pulled in a whopping $4.3 billion in pure profit.
And this right here, this brilliantly illustrates our initial paradox. AWS accounts for under 10% of the overall company's revenue, but it accounts for essentially 100% of their total profit. Think about that. This quiet, hidden cloud computing engine is single-handedly subsidizing the massive, purposeful financial losses of the retail empire. That's exactly what allows them to just crush competitors with those unbeatable shipping speeds.
Part 4. The cost of convenience.
Now, as we look at this incredible blueprint for dominance, we really need to impartially examine the heavily debated trade-offs of reaching this kind of scale. Because that relentless drive for logistics efficiency, it's led to some alleged controversies, specifically over corporate taxes and working conditions. Like, for example, back in 2011, a Pennsylvania warehouse reportedly reached a staggering 38 degrees Celsius inside. Allegedly, the loading bay doors couldn't be opened for ventilation because of strict theft prevention policies. And the reported solution at the time? They kept a paid ambulance on call right outside. Though, to be fair, they did later install air conditioning.
Furthermore, there are definitely growing tensions within the marketplace itself. Small business owners, who, by the way, make up about half of the Amazon marketplace, have alleged that Amazon actually leverages its data monopoly against them. Basically, the claim is that when Amazon sees a third-party product performing exceptionally well, they'll just manufacture their own cheaper, in-house version, undercut the original seller's price, and then rank their own product higher in the search results. As you can imagine, that makes it incredibly difficult for independent creators to compete.
So, as we wrap up this explainer, we're left with a pretty fascinating reality. You and I get to enjoy the incredible, near magical convenience of this massive logistics machine, but it is entirely powered and subsidized by a hidden cloud computing network that's literally hosting a third of the internet. Knowing the history, understanding the financial paradox, and looking at those reported controversies, we really have to ask ourselves, what is the true cost of two-day shipping? Thanks for exploring this with me today. Let that question linger, and I'll catch you in our next explainer.